Blackstone secured lending outperformance streak continues. Watch valuation. This article was written by ADS Analytics. Summary: Blackstone secured lending delivered a 3.2% total NAV return in Q3, outperforming the sector median. Bxsl trades at a 17% premium to book value and offers a 9.7% dividend yield, with net income yield on price at 11.5%. The company's portfolio quality remains high, with low non-accruals and strong diversification, though the net yield margin has fallen due to tighter spreads and higher interest expense. Bxsl is a consistent outperformer with a high-quality portfolio and low management fees, but its elevated valuation suggests waiting for a price drop to add a position. We are ADS Analytics, a team of former researchers and trading at several global investment banks. We run the investing group Systematic Income, where we scour all market sectors in our search for attractive high-yield opportunities. In this article, we discuss the latest quarterly results from the business development company Blackstone Secured Lending, Bxsl. The company has been a steady performer, as highlighted in our previous review. Its valuation has continued to increase since then, however, which makes us more cautious about entering a position. Over the quarter, the company delivered a 3.2% total NAV return, stronger than the 2.6% median in our coverage. Bxsl is a large BDC with a focus on upper-middle market borrowers. It is overweight exposure to software and healthcare companies, something we see across most other BDCs. Bxsl is trading at a 17% premium to book value, about 12% rich to the average in our coverage, and a dividend yield of 9.7%. Its net income yield on price is 11.5%. Both are well below the sector averages. Quarter update. Net investment income rose for the second quarter in a row, going against the trend of the broader sector. This was due to a $6 million capital gain incentive fee reversal, without which NII would have ticked lower slightly. The company declared a dividend of 77 cents, flat to the previous run rate. Dividend coverage of 119% is slightly above the sector average. The company's sensitivity to short-term rates suggests coverage should settle down a touch above 100% or so at the Fed's expected terminal rate. There is $1.82 of spillover, or a bit over 2 base dividends. The NAV increased by 0.3% as retained income and NAV accretion from share issuance offset unrealized depreciation. It's the 8th NAV rise in a row. The NAV stands at a record since the IPO. The company expects M&A volumes to increase with the drop in rates, lower cost of capital, and more favorable sentiment. This should lead to an increase in prepayment fees, which could, for a time, offset the downward impact of base rates. Management expects repayment rates of between 15 to 25% versus this year's 6%. The broader secular trend, however, is for net investment income to move lower over time. We could see that reflected in next quarter's numbers. Income dynamics. Net new investments were strongly positive. This was due to new share issuance and the inflow of new equity capital. This by itself will not impact NII per share to a great extent, however. The one benefit where this shows up for existing investors is in the increase in the number of portfolio companies, which rose by 26 over the quarter. This aids diversifications and lowers the size of the average position in the portfolio. Leverage was largely unchanged as the new equity capital was put to work and leveraged. Portfolio yield fell slightly, while interest expense rose, a trend we are seeing across the rest of the sector as well, due to tighter spreads, lower short-term rates, and higher coupon bond refinancings. Net yield margin has fallen from 6.95% to 5.75% over the last 3 quarters. This breakdown shows how new investments are coming into the portfolio at lower yields than the repayments, likely due to tighter spreads in the current market. Interest expense will have to fall from current levels due to the Fed's cuts to at least early 2026 when the 3.625% bond comes due. Their financing of that bond is very likely to happen at a significantly higher coupon. The company recently issued a 3.5-year beer bond of 5.35%, which gives an idea of the likely uplift in interest expense. Bxsl lists the tightest spread issuer in the BDC sector, though it is not the lowest interest expense BDC, with ARCC, FDIS, and BCSF ahead on that front. Portfolio quality. Non-accruals remained exceptionally low at just 0.2% versus a 2.6% median level in our coverage. Pike fell slightly over the quarter. There was a small net realized gain, however. On a net cumulative basis, the last 2 years are in the green. This is impressive for a portfolio that is less than 1% equity. Interest coverage on a last 12-month basis was 1.7x.3% of the portfolio, excluding recurring revenue loans, had interest coverage below 1x. Unfortunately, management did not specify the amount of recurring revenue loans, i.e., those having flat or negative EBITDA in the portfolio. About 10% of the 50-odd amendments during the quarter were credit-related, with restructurings involving a deleveraging of the position or new equity contributions by the sponsor. Return and valuation profile. Bxsl has been a consistent outperformer since its IPO, outperforming the average BDC in our coverage each quarter. Since its IPO, it is one of the strongest performers in total NAV terms. The company's base management and incentive fees have stepped up after the first 2 years, which will shave off around 0.5+% off its performance going forward. The stock's current valuation is elevated relative to its history and has only been significantly higher immediately after the IPO. On a 1Y valuation adjusted basis, the stock offers above median and average value, though not exceptionally so. Bxsl remains a strong performer in the sector. It has a number of attractive features, such as its high-quality portfolio, low management fee, and low level of interest expense. The stock's premium valuation relative to the sector is well-deserved. However, we would look for a drop in its absolute valuation to add a position. This article was written by ADS Analytics,